Hi everyone, this is a short screencast introducing corporation tax losses for independent colleges Dublin for the ACCA P6 Advanced Taxation Syllabus for FA 2013. So really as a starting point to corporation tax losses, I think the first thing to establish is how do we get a loss? And really what we're talking about here for case 1 or case 2 purposes is that the tax adjusted trading income is negative. So we'll be familiar with adjusting trading profits or net profits for sole traders, and really very, very similar adjustments for limited companies in the sense that we're adding back disallowed items and taking off any income that isn't taxable under case 1 or case 2. Okay, so just think back to how you adjusted net profits for sole traders. In this case, obviously, and as per sole traders, what we do is we don't put a negative figure into the corporation tax computation. Really, the assessment is 0, and we're looking to utilize that tax loss effectively, that trading loss. Okay, so moving on from a basic guide to how we calculate a loss, really what we're looking to say then is, well, how do we sort of use that loss? Now I'll note here that there are differences between the uses of trading losses for sole traders and trading losses for companies, and I draw your attention to those differences because that's the type of thing that your examiner will test, perhaps a comparison between the two. Okay, so the first thing to note here in terms of the use of trading losses for companies is that really we're required to follow a series of steps, and we have to follow them in order. The second thing to note here before we look at the order is really that steps 2, 3, and 4 are really optional steps. In other words, we can use them, we have the option to use them, but if we do use them, we have to use them in order. Okay, more of that a little bit later. Step number 1, which is simply to carry forward against trading income of the same trade in a future year, is obviously the same as the option for individuals, but that is an automatic option in effect. We're required to do that, so if we're carrying forward a loss, if we have a loss to carry forward, we have to use it against the first available trading income. Okay, the others 2, 3, and 4 are simply at our option. Okay, so the third thing I'll draw your attention to is in this list is really the use of the term value basis. Okay, now more of that a little bit later when we come on to an example, but essentially what we're saying is that rather than simply taking the loss in total, the trading loss, and deducting it against some income, we're really looking to use the loss as a tax credit, a little bit like we would for an income tax computation for an individual, where we're deducting a tax credit at the end of the comp. So we're not simply taking the loss and offsetting it in total. Okay. Now, in terms of these options, let's look at 2, 3, and 4 first. Really, the first thing that we're required to do, if there is trading income in the previous period, is to say, well, can we utilize the trading loss for the current year against the previous year? And that would be on a full basis. In other words, we'll take the loss from the current year and simply carry it back and deduct it from that trading income of the previous accounting period of 12 months. Items 3 and 4, we're using this new phrase, this value basis. So as I said, really, it's a sort of a credit, really. What we're looking to do is to offset against other profits, other income, let's say case 5 income or case 3 income, etc., of firstly the same accounting period and secondly the previous accounting period. Final thing that I would draw your attention to here is just this election or claim to utilize these items 2, 3, and 4 at least within 2 years. As I said, number 1 would be automatic. So those are the basic options for a company to utilize, and just remember that 2, 3, and 4 are in effect optional, but if they are taken, they have to be used in order. And number 1, the offset against future trading income would be an automatic option. In other words, it has to happen. If you have carried forward trading losses, you have to use them against the first available trading income in a future year. Okay, so moving on from here, this value basis. Well, really what we're saying is it's a little bit like having a tax credit for an individual in a comp. And what we're required to do is to literally to translate the trading loss into a tax figure and use that tax figure to offset, let's say, against other income of the preceding year or other income of the current year. So you can see a small example down here where we have a trading loss available. Let's say we've utilized it, some of the loss against the previous accounting period for trading income. And then we're onto like options 3 or 4, where we're having to use this value basis. Well, the value of that loss is in effect 100,000 euros times 12.5% being the CT rate for trading income. So in effect, what we have to utilize is this 12,500 euros. And what we'd be looking to do is to calculate tax as normal on the other income, and then just deduct what we have available. In this case, we have 12,500 euros available. Deduct that from the various portions of other income. Okay. Now, in terms of an example that sort of illustrates this, here we have, and I'll draw your attention to the BPP text, page 323 for FA 2013. We've got Z Limited carrying on a trade, has a trading loss of 220,000. So we've got to say, well, how do we utilize that loss effectively? Now, it looks as if we're given income for multiple years, not least the current year, which is 2013, but also 2012 and 2014. So it looks like we're going to have multiple uses of the loss. Now, I'll draw your attention back to our first slide there where we looked at those steps, in other words, the steps that we have to complete in order, and that 2, 3, and 4 are at our option, but if we are utilizing them, then we have to go in that order. So in this case, what you'll see is that we do in fact have other income in 2013. We have case 5 income of 10,000. And in addition to that, we do have case 5 or case 1 income in 2012 and 2014, so in the preceding year and in the following year. So we've got to think to ourselves, well, you know, how do we utilize the loss in accordance with the steps, you know? So those steps really have to be sort of rote learned, and you know, where do we go first, where do we go after that, and where do we go after that? So if you don't know the steps, it's going to be pretty difficult to lay out these answers. So let's look at how this loss is utilized given the steps in the earlier slide. Okay, I'll just draw your attention to the top of the page there where we have the outline of how we're going to use the loss. Okay, the first thing that we have to do, as we said, step number 2 really is to set the loss back against the trading income of the previous year of 12 months. And as you recall, that's not done on a value basis, it's just done as a job lot. Now I'll take you on to the next slide and then come back to this when we see how that's used. The second thing that we need to do is to really offset the trading loss on a value basis against current year. So we went back first to trading income of the previous year. Now we're moving forward against other income of the current year. And then what we do is to move back again to the previous year. And each of these second and third options are on a value basis. And you remember what we said about a value basis? It's really that we're taking the loss and we're trying to establish how much of that loss on a tax basis or value basis needs to be utilized to offset the tax that would have been paid on the other income. In this case, it's case 5 income for both of those years. And what you'll see is the last option, which is in effect the automatic option after all our other options have been used, is to carry forward the loss against future income of the same trade. Now just remember that that is an automatic loss option once the other options are used. Okay, so if we move forward just to the next slide for a moment, what you'll see is that the first option is done first. In other words, it's in fact option number 2. So if we look at 2012. And you remember what we're doing here is we're simply saying that the first place that we need to go to is really any trading income for the previous 12-month period. So we know that in 2012 the trading income was £20,000. So the first thing that we have to do in relation to our 2013 loss is offset it against that income. We have to do that first if there is income, trading income in the previous year, and that gives us a case 1 assessment of, in effect, nil. Okay, so that's our starting point. Okay, now you remember what we said is that really once we've done that, once we've gone back to any trading income in the previous year, the next thing that we have to do, just going back to the previous slide, is to say, okay, we've done the first option, we've found the trading income in the previous year. What we then have to do is to say, well, let's go back to the current year and offset on a value basis against any other income. Now we know that in this current year, this company Z Limited does in fact have some other income. And here you'll see how the value basis is shown within a comp. Really what we do is we take the income, we multiply it by the relevant rate. In this case, it's 25% for rental income under case 5. And then we have to say, right, okay, we'll have to offset the value of the tax on a value basis based on the loss that we have. So really we've got an issue of trying to sort of work out how much on a value basis we need, and in this case we needed 2,500 euros, so that equates to 20,000 at 12.5%. So that deals with really all of that income. In effect, we have a sort of a zero tax bill and a zero assessment for 2013. So what we did first is we went back, found the trading income. What we did second is come forward again on a value basis. So where do we go from there? Well, really what we need to do is in fact go back again. Yeah, so we're going back again to 2012. So I'll just move the slide forward one more time so that you can see this this loss being utilized. What we'll see here is that the other income for 2012, this case 5 income, was 15,000. So we had 15,000. Again, we just have to calculate the tax as per normal based on the 25% rate, and then to say, okay, we've got a tax bill, but we do have a loss available, and we're following our steps as per our earlier slide. How much of the trading loss do we need to offset this tax? And in this case, what we need to get 3750 is £30,000. 30,000 euros indeed. So we slot that in there, giving us in effect a nil assessment. So we really now dealt with the 2012 year as well. So really we've gone sort of, 1, 2, 3. We're only really left with one further option because we have assessments of in effect 0 for 2012 now and for 2013. So really the only way that we can go is really forward. Okay, and I'll come back to this area in a moment where we're taking the loss forward and offsetting it, remember, on a full basis, not a value basis, against future trading income. So if we just go back to the previous slide one more time, what you'll see here is that this loss memorandum for 2013, you'll notice on the next slide that we have a loss memorandum for 2014 as well. So we started off with a total trading loss of 220. Okay, we had to say, what are the steps that we need to take given our earlier slide, and we have to follow those steps. Well, the first thing that we did is we went back to the trading income of the previous 12 months. We have to do that first. Okay, once we've done that, we're then actually going to jump forward into the current year and say, okay, do we have any other income in our current year? And in this case we did. We had £20,000, but remember we have to offset on a value basis against that amount. Okay. The next thing that we do is we're sort of jumping back into 2012 again on a value basis and saying what's the other income in that year. In this case it was case 5 rental income, so we'll offset on the value basis there. So we've utilized £70,000 of the loss so far, and which would mean that the difference between that and the loss that we started off with is 150. So we've got a loss memorandum there showing what we're carrying forward into the current accounting period, 2014 in effect. So if we move forward to the current accounting period, what we'll see there is that the carried forward loss, which is 150,000 euros, we're going to utilize that on a full basis rather than a value basis against any trading income. And bear in mind, as I said earlier on, is that we have to do that. It's not our option, as it were. If you have income in the following year, you have to utilize any trading loss that you have available. So there you can see the £60,000 or €60,000 offset. Okay. Notice that the 15,000 euros in the following year is really left. We don't have the ability to offset any trading loss carried forward against that future case 5 income, as it were. Okay, so that gives us a sort of a very basic summary on a simple computation and how losses would be used on a value basis or otherwise against trading income. Okay, now in relation to a short accounting period, I mean, normally what we're doing is taking a 12-month loss-making period and obviously carrying it back for 12 months, exactly 12 months. But if we have a situation where the previous accounting period is shorter than 12 months, then what we're going to have to do is overlap or run into the period before the previous accounting period. Now what you'll see in this example here, and again I'd refer you to BPP text page 325, is we have a company called Struggle, and we have a trading loss here of 260,000 euros. Now this is obviously for a year, but you'll see that the immediately preceding period is only 6 months. So really what we're saying there is if the rules, if the legislation allows us to go back more than 6 months, i.e. 12 months, then what we're going to have to do is in some way prorate these figures for 12 months. Yeah. So we're really going to need 6/12 because we have 6 months here. We need 6 months worth of this. Okay. So in terms of the answer to this question, the first thing that you'll notice, because of the fact that the Struggle Limited had case 5 income, is that the capital allowances are offset. Okay. So just remember to net off anything if you need to net it off, and in this case we would have had to net off the capital allowances against the rental income. Now over and above that, what you'll see is this is our loss-making year here. We had a substantial loss, and we're saying, well, what can we do with that? Now you remember from our steps that our first option is really to go and find trading income of a previous accounting period. Okay, so we know that this immediately preceding period is 6 months long. So really we can offset that in total. 115,000 euros comes straight off because the loss in this period here was in excess of that. And then over and above that, we have to go back another 6 months, and we would want to do that because we want to utilize the loss effectively. And really all you've got here is really 50% or 6/12 of the trading figure. So really you can see that this is really our normal 12-month carryback, albeit for the fact that we've got 6 here, and really we're taking 6/12 of this item here. Okay, now I'll show you the loss memorandum on the next page, but really you'll recall from the steps that once we've done our immediately preceding period, on a full basis against trading income, then we've got to say, well, what are the next areas that we can go to? What are the next figures that we can offset? And really, the next figures, you remember that we go back 1 year against trading income, and then we come forward again into the current year. So you'll see that the next thing that is done here is that the other income in the current year is offset on a value basis. And you remember what the value basis means? It simply means that we say, well, what's the income? Let's just calculate the tax on the normal basis. So in this case, it's 20,000 times 25% for the investment income rate. And then we have to say, okay, well, we have some loss available. How do we utilize it? Well, really, we need to negate the tax. So we need to negate the tax that we've seen and really use this loss as a sort of a tax credit. So what you'll see here is we need this much of the loss to offset £5,000 worth of tax. And that's all we do. So that's our second step. And then moving on from there, you remember that what we need to do is to go back again to the previous year and then offset against any other income in that year. So really what we've got here is we've got 38,000 euros worth of other income. But in essence, we've got a calculation to do here on tax, and we come up with a 7,500 euro figure. And in essence, what we're saying is, can we offset all of that with the losses that we have? And in fact, we can't, because we don't have enough loss left. And you'll see on the loss memorandum on the next page, you'll see because of the way that we've utilized, or the amounts that we've utilized, we're just left with this value. So we're going to utilize it in full. There's no partial offset. We'll utilize that value in full. Okay, and once we do that, we're really left with the remaining figures, as it were. So this is just a balance here, obviously nil here because we've completely negated all income and we had a loss to start off with for trading purposes, and we've got no real sort of shelter here for the other tax that is due on the other income in that immediately preceding period, or at least that 12-month area here. Okay. So that's really it in a nutshell for a short accounting period. I'll just show you briefly the loss memorandum here. You'll see that we started off with 260. We needed to set back for 12 months, and in this case that meant sort of overlapping, because the immediately preceding period was 6 months, so we had to go back a further 6 months, and then over and above that we utilized this credit against the current year's income of 40, so we had to use 40 to offset that £5,000, you remember, and then over and above that we went back as far as we could really against the immediately preceding period's other income. And because of doing that, we sort of ran out of losses. Okay, so we have no losses to carry forward against future income of the same trade. Okay, so let's move on to other areas here. These are the other loss relief options, and I've just really listed these here. They're not as sort of popular with your examiner, John Morrison, as the trading income offset, and really these are a question of really sort of rote learning how the losses can be used first, whether or not they're carried forward or offset against current year. So it's very much rote learning and question practice, but I'd certainly draw your attention to the use of trading losses. That would be the most likely option to come up, the use of trading losses, and perhaps over multiple years. Okay, things like excess capital allowances will tend to come up as sort of small areas of questions, rather than being the focus of a larger question. But I would say trading losses, particularly for groups, are a much more common exam topic. So my suggestion with these areas is obviously just to watch out for them in questions and just sort of rote learn the uses. They're not dissimilar. Generally speaking, you're looking at a sort of a current year offset, or possibly a carry forward. Okay. Terminal loss relief, this is reasonably straightforward and very, very similar to the sole tradership option, commonly known as TLR. We're really looking at trading, and as with the sole traderships, we're looking to carry back for 36 months against the same trading income, and we're looking on a LIFO basis. Okay, so very, very similar to the sole tradership relief. Okay. Next point here, we'll know that investment, the word investment is a sort of a bad word more often than not within tax, and really what we're saying here is that we have a specific situation where we have what we call an investment company. Yeah, and that will be very, very clear from the question. And really, an investment company is a company that derives most of its income from making investments, as you would expect. And really what we're saying is that, income that it has will be in the form of perhaps interest or rents or dividends. And I think the key point here is, how are losses relevant? So really losses are relevant where we have what we call excess management expenses. In other words, we have expenses that exceed the investment company's income, and what the revenue are keen to do is really to sort of have a specific way of utilizing these losses, and so to some extent a sort of a restriction of these losses against other income. So in terms of the typical type of management expenses that you would see, obvious things for an investment company: phone, admin, accounts expenses, really direct expenses or expenses that are directly linked to the investment business. And where we have these excess expenses, in other words, a situation where the expenses, the management expenses incurred, and that will be detailed within the questions. In other words, you'll be given a list of management expenses, and it may well be that those expenses are in excess of investment income. So really the question for you is, okay, in that circumstance, what do we do? Well, it's not overly complicated, because really what we do, and apologies if you can't see the bottom of the screen there, is that we just simply carry forward against future investment income. Yeah, so in other words, we offset in full as normal in the current year, and then just carry forward against future investment income. So here we have a question called Munster Limited, and you'll see what they have is several types of income, some dividends and some case 3 interest, and we're looking to simply compute the tax payable figure for each of the years. So what do we do? Well, I think the first thing to bear in mind is that the dividends are from Irish resident companies, so therefore they're exempt. Okay, so we can exclude them from the equation completely. And really then all we do is to say, well, what are the management expenses and what's the income? So in the first year, looks like we have an excess. So we have an excess of management expenses over investment income of case 3. So we've got a difference to carry forward into the following year of 6,000. So very simply, this area is fairly straightforward, although some students, when they see that word investment, they think it looks a bit unusual. Not really. We've just got expenses in excess of income, and all we do is offset them as normal in the current year. Then we'll have some sort of carry forward losses we have in this case of 6,000. Okay, loss buying. Now, normal situation where we have a company that has a loss, as we've seen from our earlier steps, is that we carry forward the loss against future trading profits, as it were. Okay, but if we have a situation where the company is sold, there may be a restriction on the use. So really what the revenue are sort of clamping down on here is where we have the sale of the business, and perhaps there may be some reason for the purchasing company to purchase the business along the lines of access to some losses that the company has made. Okay, and what they'll do is that they'll say, okay, well, you can utilize the loss, but if there is any change in the nature of the business or change in the nature of the trade, then as far as we're concerned, it may well be that we need to restrict your use of the losses. And I'll draw your attention to these two circumstances here in which there would be a restriction. And when we say restriction, we're basically saying that, okay, the company has purchased another business. This business has case 1 losses, as it were. But as far as we're concerned, you will not be able to utilize those case 1 losses going forward because certain circumstances have come into play. And the first one really is that there's some sort of change in the conduct or the nature of the trade within 3 years of the sale of the company. And that could be anything as sort of insignificant really as sort of outlets, or perhaps changes in types of customers, or perhaps products. So it may not be something that on the face of it looks very, very significant, but as far as the revenue are concerned, if any of these things happened, for example change of outlets, then as far as they're concerned the loss has to be restricted. Okay. Second option here is just really a situation where the trade has become negligible before the sale, and then for some reason or other it's revived after the sale. So in that case, the revenue will look at that situation and say, well, it's slightly unusual for that to happen, and as far as we're concerned, we're going to restrict or not allow really the use of those losses that were in place prior to the purchase against trading income in the future. Okay, so next point here, sort of similar area, but sort of works in reverse. We're talking about groups here. We're talking about Section 400 losses, and really this is a sort of a tax break for group companies, and we'll know for group companies that we're talking about sort of ownership of 75% or more. So we have a group, broadly speaking, when we have that sort of ownership between one company and another. And really all that we're saying here is that Section 400, in effect allows a loss to follow a trade. So, for example, we have a Jumbo Limited here transferring its trade of selling carpets to a 100% owned subsidiary. So we have a group relationship here, Jumbo and Black, and we have case one losses of 1 million euros, and we have different types of trade. Bear with me 1 second, sorry. So we have different types of trade, and really what we're saying is that the transfer of the trade to the other group member, because there is a group relationship, we're saying that Section 400 of the Taxes Act allows the losses to be utilized in the new business, in other words, in the business to which the trade has been transferred. Now, the only thing that we have to bear in mind is that because the carpet trade, in other words, in which the loss was incurred, has been transferred, we can only utilize the loss against future income that is relevant to that trade and not to the trade that the new company, i.e. Black Limited, already carries on, which is selling kitchens. So in essence, what we're saying is that no particular restriction there, save for the fact that we know that the trade has been transferred, but we need to ensure that the losses that are being transferred with the trade are utilized only against that sort of old trade rather than the trade of selling kitchens. So that's a sort of a tax break, or one of the tax breaks for group companies. Okay. So that really concludes this very, very short basic screencast for corporation tax losses. Hopefully that's been helpful to you, and I'll follow this up with a short screencast on group companies and also how losses are relevant within group companies. Okay, thanks very much for listening, and good luck with your studies.